Welcome in, folks, to the channel. We got a few things to react to here today in this video. First one up here I want to react to, we're seeing Tesla come back, play out Dan Ives. I'm looking forward to reacting to that one there. Then I want to react to this one, NVIDIA. Here's why Cantor Fitzgerald has raised its price target on the stock. So we'll talk a little NVIDIA in this video. Growth forecast may be too high, says Cam Dawson. Yeah, Cam, we haven't reacted to a Cam video in quite some time. So today's that day. Looking forward to getting to that one. And then investor overconfidence is a market risk going into the second half of 2024. So looking forward to getting that one. And then lastly, we're going to talk ELF stock, right? This stock has been obviously making investors filthy rich. The performance for ELF has been tremendous over the last many years, right? Including over the past year. And so we're going to talk a little ELF. Can this stock continue to run? It's up to almost a $12 billion market cap now. Or is this stock setting up for some troubling times ahead? So we'll speak about that. Appreciate y'all joining me as always. Thank you everybody that's subscribed here to the channel. New all-time high subscribers in the history of the channel. Appreciate every single one of you. And also thank you everybody that always smashes that thumbs up button. July 4th, it's a few days from now, we're doing a big sale. I always do a sale of some kind, July 4th. And the one I'm doing this year is on 1000xstocks.com. So we're going to do a big sale on that. It's going to be pinned comment down there if you want to enter your info to have access to that sale. It's a one-day sale only. It's only on July 4th. And so pin comment down there, enter in your name, email if you want access to that deal. If you want it sent over via text message, you can put it in there and we'll send that over. And then once you join us in 1000x, you get full access. Plus you get your founding membership steel card in the mail. And, Oh, I just love it. I just love it, okay? And so, yeah, that'll be pinned comment down there. Let's get into this.
At Wedbush, what do you mean the recovery story has begun?
The comeback story for
Did it
Tesla.
need a comeback?
I think it did, because they had massive headwinds in China, and now we're seeing the comeback play out. Now, 2Q deliveries next week, I think that's really going to be the last of really some of the worst that we've seen in China. We're starting to see a mini recovery in China. The comeback kid story for Musk is starting with, of course, Robotaxi Day in August. I believe this is a stock that's going to have a massive run second half of the year.
What do you think has been then that headwind that you talked about? Is there one thing you could point to?
Look, EV demand's clearly been soft globally, but it's really about China. I mean, China was a massive tailwind for years, became a headwind, but now, Brian, you're not seeing those price cuts anymore. So you're starting to see stabilization, China demand starting to increase. And I think the stock's telling you, and we believe next week's just another sign of it, is that the worst is in the rearview mirror for Musk and Tesla.
I want to go back and...
Do I agree with Dan Ives? Is the worst behind Tesla? It gets better from here? Well, if you know my stance on Tesla, that's exactly what I've been saying before we even went into this year. I've basically been saying the second half of the year, the story gets better. The first half is going to be trash across the board, and that's exactly what's played out, right? First half of the year, bad, bad, bad. And then second half of the years, I've always had an expectation that the story gets better, revenues get better, margins get better, right? And the whole profitability story gets better, and you know, the price cuts end and all those sorts of things. And that looks like it's exactly what's going to end up playing out. It looks like the second half of the year will get better. So it's a possibility it won't happen, but it looks very likely at this point in time, my personal opinion. So yeah, that's what I've been saying, honestly, this whole year.
Fine, you're a good guy and you roll with things. You heard the top of the show, okay? And I built these Trump and Biden portfolios that I had. In my original one, I had Tesla because I thought we decided, we're not really sure. With Tesla, if Trump wins and rolls back some of these EV financial incentives, don't know if he will, but let's say he did, would Tesla have a natural advantage over its customers?
T-Man won't roll those back. He talks negatively in campaign speeches about EVs. Mainly, it's basically kind of like for show, essentially. And it's going to get people to feel like one side or the other, like, oh, these are the enemies. But he's not actually going to roll it back. You just watch.
Because of its price point. In other words, are they kind of, dare I say, a Trumpy portfolio type company?
Oh, I'd say, Trump pro-Musk. And I'd say it's bullish. A Trump presidency would, at the end of the day, be bullish for Tesla, negative for EVs. Then we saw that when you showed that across Rivian and others. And I think it also speaks to the Biden administration. Musk has really been an afterthought. in a Trump administration.
Well, he's been actively ignored.
Actively.
President Biden, I think 2 weeks ago, tweeting out something like, we're going to make EVs in America. And like he got ratioed and people are like, Tesla? and already does?
And I think if Trump's in the White House, Musk gets more front and center. That's bullish for Tesla, especially if you start to see those EV rebates roll back. Negative for the industry, bullish for Tesla.
But that's the point. If somebody decides to buy an EV Silverado from GM, in part because they get $7,500, right? If that goes away, they might say, I just can't pay for that. I'm going to go with a Model X.
And they've already scaled. If you look at their scale and you look at their pricing, they are in a massive position of strength. And that's why I think as you start seeing more signs of Trump presidency, that is bullish for Tesla.
Yeah, I wouldn't say T-Man or B-Man is necessarily bullish for Tesla. The bottom line is Tesla's going to put up their numbers regardless over the coming years. So, and the biggest thing that will move Tesla has nothing to do with who's the president of the United States. You know who it does? There's one man that matters significantly to Tesla's demand. Do you know who that is outside of Elon? Jerome Powell, Federal Reserve. What does the Fed do with interest rates over the next few years? Obviously, it's gotten a lot more expensive to buy a car, right? Because most people buy cars on loans. And so being that the Fed has interest rates right now, Fed funds rate, by far and away the highest it's been in the past 10, 15 years, right? If he can start lowering rates, it's going to help out Tesla immensely. Anybody that sells anything high ticket, right, which is something that's 5 figures or more, is going to be helped out massively when interest rates are finally lowered, right? And so that's going to play out. That's going to matter more significantly than who's in the White House. Next one up here, NVIDIA. Here's why Cantor Fitzgerald has raised its price target on the stock.
How many times have you raised it over the last year or so as NVIDIA just kind of continues this upward trajectory?
Yeah, good morning, Leslie. It's probably 2 or 3 times. I think the great bang was, a year ago, when you had that massive beat in August. And, I think since then, data center has continued to surprise. Wow. But when you
Did you see that price target? $175 they have NVIDIA going to.
Step back and you think about acceleration inside
Which doesn't surprise me. You know what I've said a long time ago. I said, $1,500, maybe $2,000 a share. And so that's $150, $200 on a split adjusted basis, right?
Looking forward, we're only about 8 or 9% penetrated, and Jensen's view of the world is that we're going to 100%. And if that's right, there's a long runway ahead, and I would surmise that the street will be raising its price targets for many, many, many times over the coming years.
Do you think that at these levels, the pace of innovation that you describe, the runway that you describe, is already priced in, or do you think it's still misunderstood by the market?
I don't. I think that the seismic shift last year was the announcement of moving to an annual cadence in terms of new technology releases. And it's a very powerful change statement where essentially I think Jensen is basically saying to everyone else that he competes with, catch me if you can. And his holistic view of the data center as one large GPU means that he's not only investing in core GPU, but CPUs, the networking, overall networking fabric, all of the connectivity. And, I think that if he can do what he has done in the prior decade over the coming decade, that the game.
That's a sweet 2-year, is it not? 632% on a 2-year basis. You got to be flipping my flapjacks.
That he will offer, and the reduction in the cost of compute will truly make AI ubiquitous.
What companies, CJ, or whole sections of this industry, therefore, are effectively dinosaurs? Because if that's what's happening and they're taking over all these other functions and creating a new kind of galactic computing platform, there have to be net losers that would otherwise be getting, these orders and this much capital investment.
Yeah, it's a great comment. I think Broadcom did a great job talking about kind of NVIDIA's mainframe strategy, as they call it, versus more of discrete best of breed. And, I think that NVIDIA is really securing the training market. But I do.
That's crazy. 54 analysts have a buy rating on this and 7 have a hold. Jeez.
Inference market, will have an opportunity for many other players, whether it's custom silicon, by Broadcom Marvell, or whether it's AMD with their own GPU. So I do think that there's, a big enough playing field here for success for all those companies. But if I think about the company that's going to grow the fastest and hold the dominant share, I continue to think it'll be NVIDIA.
And yet
Do I believe it will continue to be NVIDIA? Yeah, absolutely. Absolutely. It's going to continue to be NVIDIA for years to go in the future. Can they be replaced 10, 20, 30 years from now? Maybe. But for the next at least 5 years, it's NVIDIA's game. And if not the next decade, if not the next 2 decades, it's NVIDIA's game.
in your note that, quote, AI ROI remains a bit of an enigma today. What do you mean by that? And kind of what are you hearing from your channel checks on that front?
So, when you take a step back and think about NVIDIA's data center business going from, $1 billion or 2 a quarter to now $25 billion and obviously moving even higher over the coming quarters and years, it begs the question, what's the return on this investment? And, I think today we're sitting in such early innings that it's going to be hard to see. What we tried to outline in our note this morning was, give certain use cases, whether it's in biotech or whether Walmart or things like that. And it's, I'd say it's the rightful, question mark, but I think it's hard to truly get a bottoms up vision to the benefits of these investments. But obviously that's the key question, because if there isn't an ROIC, then at some point these investments will have to stop.
Return on invested capital, 100%. Yeah, and then that's the risk for NVIDIA, right? But let's be very clear, NVIDIA has basically insane demand until when? Until 2026. It's basically a guarantee, looking at MU's numbers here and what NVIDIA is talking about, it's basically a guarantee that NVIDIA has insane demand through 2025. 2026 and 2027, we're now kind of thinking like, okay, are they going to continue this insane demand in 2026, right? That's the year right now that people don't know about. But basically, we know about this year, we know about next year, it's going to be insane demand. So the whole debate now is what happens in 2026, right? Which we honestly won't know much more information on that probably until, I would say, the end of this year or the beginning of 25. Hey, Cam.
Host 9. Welcome back. It's good to see you.
Good to see you.
So what's up with today's action, right? The PCE came in line, no surprises whatsoever. Yields are elevated, and after hitting these new highs for the S&P and the NASDAQ, we kind of rolled a little bit.
Yeah, we are extended and overbought, and maybe that is a little bit of what's going on, which is that the PCE was good. It was right in line. You did see some revisions higher in last month, so maybe that caused people to say, oh, all the data isn't great. But we have to respect the fact that though the trend is higher, in the very short term, you are hitting this wall. We're in the blackout period for share repurchases. You're overbought. You have very extended valuations positioning. It's not surprising to see this little bit of a breather. We'll see if it continues, though.
I don't know if you were one of the voters in our Delivering Alpha quarterly poll here, but we did ask people what's next for stocks. 36% say we're due for a drop of 5% or more by autumn. Now, it's always hard to read into that because you could say, well, we haven't had hardly any volatility, and we're only due for a drop because we really haven't had a drop. And when we have, it hasn't been even 5%. So what does this all mean?
So this is hilarious. Due for 5% drop or more by autumn, for fall time, 36%. They'll keep going higher, 5% or more by fall, 32%. We'll settle into a range for the next few months, 32%. Why is that hilarious to me? Well, it basically shows that there's absolutely no conviction in where the market's actually headed. Wow, no conviction, which makes me think more of we'll settle into a range for the next few months if everybody's kind of convictionless on if the market's going a lot higher or a lot lower from here.
Where we go from here, do you think?
I think that some of this momentum can continue into July. We do know seasonals are typically supportive in July, but then you start getting into August and September, and you start looking around at some of the things that could drive the market higher. One of the things we're talking about is that earnings for 25 are starting to look really aggressive, very elevated, and that's when you start seeing analysts roll forward their models and consider, are we properly properly calibrated for 2025. We've also seen this deteriorating in some of the economic growth. Atlanta Fed GDP now was just revised down to 2.2%. So how does that square with GDP forecasts, which still remain elevated?
So is this one of the biggest risks then, that earnings are too optimistic at a time when valuations are already what you would say are historically elevated?
Yeah, that's the high bar to jump over, which is that valuations have already priced in great news, earnings are pricing in great news. Now, the point is that earnings are still moving high.
Liquidity bellwethers softening, crypto, speculative plays, weaker economic data could spark growth forecast cuts, stretch valuation sentiment position. That's all fair.
2025, and your 12-month forward numbers are still trending higher. That's why this market remains so resilient. The question is, if you start revising those numbers lower because you're revising GDP lower, or you're saying that certain expectations are too aggressive, like margin expansion, which has in at 100 basis points, incredibly aggressive, if those start to be revised lower, that's when we think you could hit more of an air pocket in the market.
I've heard people make the argument that...
That's fair, and think about it like this, right? Meta's guide was a little weak. Amazon's guide was a little weak. Shopify's guide was a little weak. Many of the most impactful companies in the market, right? We know Apple's been going through troubles in their business model, right? So Microsoft's guide, a lot of people looked at that and it wasn't as strong as some people had hoped for. So from that standpoint, let's say we have another quarter, this next quarter that's reported here in a month or so, right? Let's say we have a dynamic where a lot of these big dog companies then go ahead and once again, let's say guide a little lower than where Wall Street's at, then everybody starts to freak out, because then it would be back-to-back quarters where guidance is coming in weaker than analysts are expecting, right? And everybody would start to freak out at that moment, and oh boy, it's going to be a weak holiday shopping season, right? And then on top of that, just kind of like there's some sort of consumer weakness going on. And then people start to worry about their 2025 numbers. And they're like, oh man, we're too high with our revenue estimates or EPS. And then you have a freak out in the market. And that's when you can actually have a double-digit correction in the market. When I say double-digit, I'm talking a 10% or more correction in S&P 500. So now if we go into this earnings, Amazon, Meta, all these companies, they guide in line, or let's say a little better, then you're not going to get that correction. But I'm telling you, if you're going to see, you know, all these companies, these big dogs say, you know what, our business is a little weaker than we thought and you guys are thinking, you'll actually see the market correct pretty heavily, because everybody will freak out at that point in time, and then they're going to have to bring down 2025 estimates. And so that'll be a whole game that plays out, and you'll see the market drop 10 to 20% in that amount of time. So it's just a little food for thought, right?
You don't want them, because at this point, it's going to mean that something's wrong, that the economy's slowing, that maybe it gets to the point that the Fed has to step in rather than wants to step in at that moment, because they're not fully confident that inflation is close enough towards target.
Rate cuts because you can are great. Rate cuts because you should are bad. And one of the things that we're seeing is finally starting to see the impact of higher rates on this economy. 100%. Look at the housing data. Look at the capital goods, the durable goods. You're starting to see this weight of higher interest rates on some economic activity. It's not bad enough yet to call and pull the recession alarm. We don't think we're slipping into a recession, but it is enough to suggest that maybe growth forecasts are a little bit too high.
That says to me, you probably think it's too soon to expect much broadening out of this market.
I think so. The thing that has been the key driver of the narrowness of the market has been earnings narrowness. The S&P equal weight earnings have continued to be revised lower, whereas the Mag 7 continued to be revised higher. If you look in the back half of the year, though, the bar is highest for the 493 of the S&P 500. The consensus has those estimates going up to the high teens in the third quarter, the fourth quarter, and the first quarter 2025. So that's actually room for further disappointment. So unless there's a good earnings reason for the market to broaden out, we don't think it will.
You know what really bothers me? Let me show you guys something that really bothers me about this market right now. I'm going to show you guys right now. By the way, Celsius stock down to 57 bucks. How about that? Let me show you guys what really, really bothers me. It's right here, okay? This guy right here, this Russell, this dang Russell refuses to do anything. I mean, my gosh, it refuses to do anything. Where are we at here? We go back Jan 2021. I mean, geez, you know, this Russell is just kind of stuck. We're waiting for it to break out. It seems like it's stuck around this 2000 level. And that's one of those things you look at. If the Russell's rolling, then there's going to be more confidence about the economy moving forward. We just haven't seen the Russell really do that breakout that we really want to see, get back going 2,100, 2,200, 2,300. And which shows you there's really, at the end of the day, there's still not confidence really in the economy or where the Fed is headed. So when the Russell finally starts to run, I would start to actually feel better about the economy and what's likely going on there and where the Fed's likely headed. But right now, the Russell still is in this kind of stagnation period and just kind of stuck in that 2,000 range right now. Investor overconfidence in the market is a market risk for 2024 second half.
Confidence over the next 6 months. Chris Harvey is the firm's head of equity strategy. Chris, welcome. How do you react to what Tim just said about the consumer maybe getting a little more timid? Are you seeing any signs of that?
So Tyler, what I think is happening with the consumer is you don't have to worry about the consumer buckling under. The finances are okay. What you have to worry about is where he or she is going to spend their money, right? What we're seeing is the consumer saying, I'm not paying that for that, right? And where are they spending their money? They're spending it in Costco. They're spending it in Walmart. They're spending it in TJX, in Ollie's, in Burlington, off price. What is that telling you? It's telling you that they're stretched. They're not finding a lot of utility in the market, and they're being very, very selective. And that's what we should expect going forward. Don't expect a ton from the consumer, but the consumer's not going to knuckle under at this point in time. They're just going to be very, very selective.
Let's talk about the great hero of the first half of the year.
That's actually a really good take. That's a really good take. Because that's exactly kind of how I view it out there. Consumer has to be very selective. They've been hit by inflation for 3 years, right? And then got hit with the Fed moving rates up so dramatically, which makes the cost of buying anything on debt so much more expensive for folks. So that's exactly kind of how I feel. We're at this stage with the consumer where the consumer will still spend, but they're really watching what they spend on, right? And you're not seeing nearly as many frivolous purchases. That's why a lot of these luxury companies that sell luxury, purses and different things I have seen a lot of trouble in their numbers, right? People are just really watching what they spend on and making sure they're only spending on, absolutely the things that they really view as necessities and the things that they really, really value. There's not as much silly spending going on out there at this point in time. I'll say that, right? With that being said, if the consumer was to continue to get hit by inflation, right, and the Fed was continue to keep rates at a very elevated place for another year or so, there is a potential that the consumer could then buckle. So that's an important thing to keep in mind, and that's where you see just a massive kind of deceleration, or I shouldn't even say deceleration, I should just call it a drop in revenues for a lot of companies out there. So let's hope we don't get to that place, but for now, I think his take is actually really, really good there.
NVIDIA, which has been on Wells Fargo's sort of hot list for quite a while.
Yeah.
What do you see in NVIDIA? Yeah. Is it, if you own a bunch of it, is it time to trim? Some people are doing that. Because it's become such a large part of their portfolio, so there's some inertia.
Listen. I'm going to be point blank about this. Silly. Just because a stock became a big portion of your portfolio, there's not a reason to sell the stock. If it went up a ton, so it became a huge position, like great, that means the company's doing great. And as long as the valuation's there and the growth rates are there, you should continue to hold that. For instance, if you look at the public count, Meta's a massive position in the public count, right? And it's not because I necessarily put a crazy amount in it, it's just it's gone up so much. I think we're up 300-something% on NVIDIA. I think I put 200,000 and some change into that stock, and now the position's worth 800,000. We're up like $600,000 plus in that position. And it's a huge weight because that portfolio is 2.2 mil, right? Huge position, but it's not like I'm like, oh, I got to go sell Meta just because it's a big position. No, that's silly. If Meta's still very undervalued, you got to continue to hold that stock, right? Same thing with a stock like NVIDIA. So to sell just because a stock's become a big portion of your portfolio is a silly reason to sell. Very silly.
Tyler, that's exactly what
I did a great video. Well, in my opinion, it's a great video about a week or so ago on the main channel about the reasons to actually sell a stock. That video was very helpful if you ever need to, why should you actually sell stock? Watch that video. It's called, selling stocks or something like that. I titled it. It was about a week ago. I put it on the main channel. A very valuable video.
So we have it in our SIG Picks portfolio, right, which is our best ideas portfolio. It's been a top idea.
Sig Picks, not
Just rolls off the tip of your tongue. That's why you named it that.
The Signature Picks portfolio. I'm going to take a little lead on that one.
That's 6 Picks. Okay.
So it's been a top idea for a while. It's performed, as you know, exceptionally well, and we just keep bumping up into our risk controls. So we trim it back, but it still remains one of our top ideas. And the bigger picture, right? NVIDIA is part of that momentum trade. And so is that momentum trade going to bend? What is it going to do? We think that the momentum trade is only going to bend here. It's not going to break because a lot of the macro factors that you need to break it just aren't where they need to be, whether it's credit spreads, whether it's the valuation of the contrarian basket, or whether it's the economy, which is not accelerating.
So you're a little worried about investor overconfidence, but not all that worried, it would seem.
No, because what I think is this is a period in the market where people put on more and more risk. You're not getting penalized for putting on more and more risk. At the beginning of the year, many people thought the Fed would be cutting several times at this point. What was their penalty? S&P up 15%. When that occurs, I feel pretty good. It's like at Vegas. Just put in the middle and let's keep it going.
Anybody have a quick question for Chris before we let him go?
My man looks like he loves Vegas.
So how much of the seasonality are you putting into it? How much of the election year cycle are you putting into it? And then when you're rolling in, not to get too far ahead of us,
right,
but when you look at Q1 of 2025, whoever is in office right there, is it a let the air out of the balloon event?
Right. So a lot there. So the first thing I would say is that the presidential cycle is really important. And we saw what happened with the debate, and former President Trump's probability went higher. That's really important to the market because if he wins, the probability that the Senate goes GOP also is very high. What does that do? It's a less regulatory strict environment, right? So what you should see is more M&A activity. Get more M&A activity, more IPOs, more risk seeking, and the market can go higher. And traditionally, with a GOP Senate, that's a very good formula for the equity market.
Yeah, no doubt. And I think the biggest thing with, T-Man potentially getting elected is that takes the wild card out of, because B-Man's talked about potentially raising corporate tax rate to 28% from 21% right now, which would take 7 percentage points away from corporations getting that money, and instead it's going in the government's pockets, right? And so, yeah, that would be not ideal for the stock market, right? The way I would think about that is if that happened, basically the S&P 500 should go down 7% minimum in a situation like that. If T-Man's elected, then that takes that out of that. So, that's a big risk that just goes bye-bye, essentially, okay? Now, Elf on the Shelf stock obviously continues to perform tremendous, right? It's just been an amazing stock for the last many years, but even the past year, right? And even year to date. So in regards to Elf on the Shelf, can the momentum keep going? Well, here's the deal, okay? The company put out actually relatively low earnings per share estimates and actually revenue estimates. So if we're in a situation where the company comes in and considerably beats their revenue estimates and their earnings per share estimates over the next couple of quarters and then ups the overall yearly numbers, we could be in a situation where ELF actually pushes more to 250. Now, if they just come in line or anywhere close to in line with their numbers, the stock could actually fall back down to the 180 level, 175, something like that. So now, if I had to guess, my thought is they're going to probably come in and beat numbers pretty considerably throughout the year, which will help the stock. And next thing you know, you'll see a 225 on the stock at 250 handle on this baby. The forward P is certainly not cheap, but given the growth rates this company continues to put up quarter after quarter after quarter, it obviously deserves to trade at much richer multiples than the market in general, right? So ELF continues to be in I would say, a pretty good position overall. I continue to be pretty happy with, what we're looking at here. And if I view it versus some of these other companies, sure, the P metrics are much higher, but ELF is seen as a company that's going to have better growth and better long-term growth, and it's seen as a more stable business model than, let's say, chip companies or something like that, right? Because at the end of the day, chip orders could be insane at a particular time, and then next thing you know, the big dogs, they all slow down on the amount of orders they're doing. ELF is cosmetics. It's beauty products. Like, people run out of these, and they got to go buy more, right? And so it just continues to be used more and more and more. So anyways, if you never studied ELF, I would. Listen to their latest conference call. You can search it right here on 1000X. and listen to our latest conference call. I think you get a lot of value out of that overall, folks, okay? All right, appreciate you joining me as always, folks. The 4th of July sale is coming up here quick. It's in a few days from now. It's a 24-hour only sale. If you want to enter in your info to get access to that sale, do so with the pinned comment down there. You can enter your name, email, we'll send it over, and then you'll get your Steel membership, your founding card in the mail, sent to your house as well. Much love and have a great day.